Welcome back for the third part of Chapter 4. Before we get started, I have a brain teaser for you to check out how much you retained from our last video. Can you answer the following questions? Please pause the video to see if you've got the answers before moving on to our discussion about accounting for merchandise sales. You'll find the solutions in D2L. Merchandise inventory consists of products that a company acquires to resell to a customer. True or false? Number 1. Number 2, a company had sales of $350,000 and cost of goods sold of $200,000, which means gross profit is equal to $550,000. Number 3, merchandise inventory is reported in the long-term assets section of the balance sheet. Number 4, purchase discounts, allowances, and returns are all added to the cost of merchandise inventory. Number 5, a perpetual inventory system continually updates accounting records for inventory transactions. Number 6, quick assets include cash, inventory, and current receivables. Number 7, with credit terms of 210, net 30, the seller is offering the purchaser a 2% cash discount if the amount is paid within 10 days of the invoice date. Otherwise, the full amount is due in 30 days. And number 8, shipping terms of FOB shipping point means the purchaser pays no freight cost. All true or false? Good luck on these. So last session we looked at merchandising transactions from a purchaser's point of view. As you likely remember, all costs of inventory, including returns, allowances, and discounts, are accounted for in the cost of merchandise inventory on the balance sheet. It's an asset. Today, we'll review the accounting for those same transactions, but from a merchandise seller's point of view. When a merchandiser sells the inventory, however, there are new journal entries, and there are 2 new accounts to consider. So a summary of our topics is included in this slide. We look at inventory sales, cash discounts, which has a new sales discount account, returns and allowances, and a delivery expense account for transportation. Now, as you might imagine, merchandising companies also must record and account for sales, sales discounts, sales returns and allowances, and cost of goods sold. GAAP tells us that sales discounts, returns, and allowances are actually a reduction of our gross sales price. So let's explore that a little bit. Sales returns, allowances, and discounts are defined in a similar manner to what we saw on the purchase side. Sales return refers to merchandise that customers return to the seller after a sale. Sales allowances refer to reductions in the selling price of merchandise sold to customers. Both sales discounts and sales returns and allowances are accounted for as contra revenue accounts. This means they have a normal debit balance and are subtracted from the sales account to arrive at net sales on the income statement. We record these amounts in separate accounts because it is important for management to understand how much discounts, damaged goods, and dissatisfied customers are costing the company as a percentage of revenue. Okay, does this make sense? So beyond GAAP, part of the reason we account for transactions using the accounts we do is because management uses our accounting information to make decisions. Financial statements published for external users will generally report only net sales. And finally, cost of goods sold, which is the total cost of merchandise purchases we learned about last time, is deducted from net sales to come up with gross profit. Now, each sales transaction from a seller of merchandise involves 2 parts. First, revenue is received in the form of an asset from a customer. And secondly, recognition of the cost of merchandise sold to a customer is recorded. Okay, so accounting for a sales transaction under the perpetual system requires recording information about both of these parts. This means that the sales transaction for merchandisers whether it's on cash or whether it's by credit, requires two entries. One entry records the revenue, and one entry records the cost of the inventory sold. To, to illustrate then, Zmart sold $2,400 of merchandise on credit on November 3rd. The revenue part of this reflects an increase in Zmart's assets in the form of accounts receivable, and it also shows the increase in revenues. If the sale is for cash, the debit is to cash instead of accounts receivable. Now, the cost part of each sales transaction ensures that the merchandise inventory account reflects the updated cost of the merchandise available for sale. For example, the cost of the merchandise Zmart sold on November 3rd is $1,600, and the entry to record the cost part of the sales transaction decreases the merchandise inventory account with a credit and increases the cost of goods sold, that's the expense account, with a debit. Sales discounts on credit sales decrease the delay in receiving cash and may reduce future collection efforts. At the time of a credit sale, a seller doesn't know whether a customer is going to pay within the discount period and take advantage of the discount. So this means a seller usually does not record a sales discount until a customer actually pays within the discount period. Now let's look at an example. Zmart completes a credit sale for $1,000 on November 12th with terms of 210 net 60. The entry to record the revenue part of this sale is to debit accounts receivable and credit cash for $1,000. Now notice that the entry records the receivable and the revenue as if the customer will pay the full amount. But the customer has two options. One option is to wait 60 days until January 11th and pay the full $1,000. Now, in this case, Zmart records that payment as a debit to cash and a credit to accounts receivable for $1,000. The customer's second option is to pay $980 within the 10-day discount period ending November 22nd. If the customer pays on or before November 22nd, Zmart records the payment as a debit to cash for $980, a debit to sales discounts for $20, this is 2% times $1,000, and a credit to accounts receivable for the full $1,000. So remember, sales discount is a contra revenue account, meaning the sales discount account is deducted from the sales account when computing a company's net sales. And management honestly really monitors sales discounts to assess whether its discount policy is effective and whether it's cost efficient. Now, sales returns refer to merchandise that a customer returned to the seller after the sale. Many companies allow customers to return merchandise for full refund, right? Sales allowances, on the other hand, refer to reductions in the selling price of merchandise sold to customers. This can occur with damaged or defective merchandise that a customer is willing to purchase with a decrease in the selling price. Sales returns and allowances usually involve unhappy customers and the possibility of lost future sales, so managers monitor the information about returns and allowances. Our accounting for returns is quite different from the accounting for allowances, as we'll see in the next two examples. Now recall that Zmart's sale of merchandise on November 3rd for $2,400 had a cost of $1,600. And assume that the customer returns part of the merchandise on November 6th, and the returned items sell for $800 and cost $600. So the first entry reflects the decrease in sales from a customer's return on merchandise by debiting sales returns and allowances and crediting accounts receivable for $800. If the merchandise returned to Zmart is not defective, if it can be resold to another customer, that's what any company would hope, Z-Mart puts these goods back into inventory, and then the entry to restore the goods to merchandise inventory is, you all probably know this, it's to debit merchandise inventory and to credit cost of goods sold for $600. This entry is simply just the opposite of the entry recorded when the sale was originally made. To illustrate sales allowances, on the other hand, let's assume that $800 of merchandise Z-Mart sold on November 3rd is defective, but the buyer decides to keep it because Z-Mart offers a $100 price reduction. Z-Mart records this allowance with a debit to sales returns and allowances, okay, this contra account, and a credit to accounts receivable for $100. There is no entry made to merchandise inventory or to cost of goods sold because there's no inventory that was returned to the customer. Now recall that sales returns and allowances is a contra revenue account, meaning again that it's deducted from sales when computing net sales on the income statement. So in summary, net sales equals sales minus sales discounts minus sales returns and allowances. This means that net sales is the amount that the customer paid for the goods bought. And finally, I'm providing you with a summary of new sale-related accounts: sales revenue, cost of goods sold, sales discount, sales returns and allowances. For your information, this information is in the textbook as well. So that's it for now. When you return for part 4, we'll discuss period end entries and reporting for merchandise sales. See you soon.